So I think we'll quickly get started. We are a couple of minutes late, but it's okay. So if all the panelists can switch on their video, then that'd be great. Yeah, thank you. Um, so welcome everybody. So I'm going to do a quick intro and then I'm going to pass it on to the moderator. So a warm welcome to all of you. We hope all of you and your families are well and safe. Before we start, I'd like to make a quick request. If you're a non-panelist, please have your microphone and your video feed muted for the full session so that there's no distraction for the speakers. We'll have a Q&A at the end of the panel discussion, the last 20 minutes. But in the meantime, you can start, sending your questions, and then we will try and answer as many as possible in the last 20 minutes. So anyway, first and foremost, right now, companies are focused on keeping their employees and businesses safe in these turbulent times. So with increasing uncertainty, many corporate leaders are being asked to make strategic decisions. The big question is will an economic downturn, coupled with the shutdown and or the decline of equity markets create a buy-side opportunity? Are companies really thinking about divesting non-strategic assets to raise more capital? So going with that theme, our topic today is M&A in a post-COVID-19 environment, opportunities and strategies. The session is jointly hosted by KPMG Sri Lanka and BOV Capital. I'll do a quick intro of the panel. So we have Kasturi Wilson, who's a managing director of Hemas Pharmaceuticals, Logistics and the Maritime Cluster. Vishantanu Nagpal is a co-founder of Bluestone Capital. Bluestone Capital is a Lankan-based investment fund. We have Imal Kalutotege, who's a co-founder CEO of Nsinga. Nsinga is an IoT-based tech company focusing on digitizing the apparel manufacturing sector regionally and probably globally. Nsinga was recently acquired by Zilingo, a large Singapore-based tech company. And the final panelist is Krishan Pereira, who's CEO of Omac Technologies. Omac is a restaurant software company. So we need a moderator, and today's moderator will be Shiluka Gunawardana, who's a principal at KPMG Sri Lanka in the deal advisory practice. So welcome to all the panelists and the moderator, and I'm going to pass it to Shiluka now. Shiluka, to you.
Thanks, Sean. So good afternoon, everybody. So let me just run you through the structure of the discussion today. I'll do a bit of an overview, and then each panelist will have about 5 to 7 minutes to talk about certain questions based around their specific areas of expertise. We'll then have a Q&A session for about, depending on the length of questions. And if you have some further time available, there'll be some follow-up questions to each of the panelists. I'm aware that it's a Friday afternoon and we all have to go back and celebrate the weekend that is coming up, hopefully the last weekend and the curfew. So we'll try and finish by 5 p.m. So getting on to my thoughts, and this is as an advisor, what we see today. So both locally and globally, there is essentially, I would say, almost a freeze on transactions. Some have been canceled, some have been postponed definitely, and some are just on a wait and see mode. Issues being around, obviously, this was availability of credit. If you take Victoria's Secrets by L Brands to a private fund, and the fund pulled out, and now that was announced where Facebook is taking a stake in the digital assets of Reliance. It's a $6 billion deal. It's been some time in the making, but announced this week. And interestingly, it's the largest transaction Facebook has done after acquiring WhatsApp. So there's always space for transactions, even in these times. I think the key issue that we see and will come across is around valuations. Most of the companies we talk to, even in our own businesses, we have issues around forecasting revenues for the next 6 to 12 months. On top of that will be problems in terms of the whole business model for certain industries and how that will pan out, challenging both and buyers and sellers in the market. And coming from that is the fact that even on transactions that are currently ongoing, we see buyers wanting discounts, or the fact that they want majority of the purchase consideration will be paid towards the end of the transaction, or back-ended or through earnouts. So we have a current live transaction where the seller is willing to take almost 25% on the value.
Hey,
Simply
Shiluka, sorry,
because
there's a bit of breakup on the call.
among other things, the counterpart is a foreign investor, and we are seeing sellers taking haircuts on valuations, and primarily that is because of the fact that they would like to take liquidity and maybe a stronger partner on board now versus down the road. Another problem is around due diligence. Going forward, asset quality in balance sheets, whether it's receivables or inventories, would be challenging in terms of assessing impairments. And similarly for the banking sector, if you look at any of the financial institutions for the next 12 to 24 months, the quality of the book would be quite interesting to look at. I mean, most of the issues will probably take time, 6 to 12 months to come out, but on a due diligence basis, that would be a problem. We're also seeing some innovation in terms of transactions. I mean, transaction closings are happening on, I read an article recently that they're using drones to survey facilities, especially on the real estate side. So people will work around, there will be workarounds, especially going forward, but simply on a financial statements basis, there will be challenges to come. I think in terms of what we see going forward, potentially in terms of opportunities, there are pools of capital that are looking at distressed assets, be it companies, be it real estate, or even in terms of loans. These opportunities probably will start coming around in the next 6 to 12 months, especially once loan moratoriums end. We're also seeing interest in pipe transaction, that is private investment in public markets. From a corporate point of view, there is both the liquidity, attraction of liquidity, plus also a signaling effect that investors come on board. There will be, and I think we'll talk about this further on in the call, a new set of sunrise industries and a new set of sunset industries. I think capital will follow accordingly. We will also see consolidation, especially of maybe the larger players rolling up some of the smaller players in the sector. I personally feel in the financial service or some parts of the financial services sector, we will see significant consolidation going forward. So I think to really wrap it up, it's that buyers, sellers, and transactions will need to get more, and also that we will see a more efficient usage of capital in the future versus some of the more exuberant transactions we saw in the past. People will be more rational in terms of valuations and expectations. So that's my Kasturi. I think you come from a corporate conglomerate that has been involved
Hey, Shiluka, hold on.
In the past,
Shiluka, let me stop you for a
quite
second.
a number of focused transactions. We've also
Shiluka, there's a lot of breaking on the call.
Businesses. So in the context of that,
I think
is it clear now?
Shiluka, you will have to re-ask the question because I don't think anybody heard it, nor did I. And
Shiluka,
sorry.
Shiluka, also switch off your video.
Let me stop the video. Yeah. Okay. Right. So Kasturi, sorry. So you come from a corporate which has done M&A in the past, quite a few significant transactions. The group has also divested non-core businesses. So in terms of your presentation, we'd like to cover a few areas. One would be you overlooked logistics and pharma. How is that sector currently doing? And how will it be in the future? What you foresee of to see in terms of opportunities for M&A? Is that something of interest? And what again, on a more holistic level, I think HEMAS deals a lot with the SME sector, a sector that certainly will be under stress. How would a corporate like HEMAS look at working with the SMEs going forward post-COVID? Over to you.
So Shilaka, just for me to understand what you asked, because you broke up again, you're talking about, you asked me about the pharmaceuticals healthcare sector. Is that correct?
Yeah, pharma and logistics.
Fine.
Where you see it heading?
Yeah. Good evening, everyone, and thanks to BOV and KPMG for having this event. So from a HEMA's point of view, yes, you're rightfully, we've been, if you see the last 5 years, we've been going through having some acquisitions, which are either in spaces we are familiar with, and we have also been cleaning up our portfolio in terms of shedding some of the non-core businesses and assets we've got. So now we are predominantly a wellness, healthcare, FMCG player with mobility, which is logistics being a facilitator and a core business as well. During COVID, we understood that especially healthcare, pharmaceutical and logistics, both played a critical part in in businesses which operated during COVID lockdown, right? However, if I take pharmaceuticals, we found that we are one critical player, but down the value chain, right up to the consumer, there are other SMEs which play a big part in it. How do we, and we realized it was one industry which had to work with government, collaborate with competition, collaborate with all partners in the value chain in order to get this medicine to a consumer. Going forward, I mean, it made us think that it's a highly regulated industry. There were so many do's and don'ts and perceived in our minds as well as through regulation that you couldn't do, which everything was put to rest when all boundaries were broken and we had to execute and do whatever we could to get this accessibility of medicines to patients. So what we've seen now is that the agility point of view, scaling it up and being agile at grassroots level, big corporates struggle with. We overthink it, we overcomplicate it, and the success stories were finally the small community guy who mobilized a couple of trishaws or whatever and set up his own and integrated with a bigger company or a retailer in that area. So it's giving out some interesting models. Does a corporate have to get into that business? I think the corporate necessity has to look that that's the way forward. And how do you partner or integrate to those kind of businesses in right down the value chain is on the healthcare. But most interesting is in the logistics side of it. Going forward also, post-COVID, it's social distancing, logistics with minimum amount of contact is important. How do we do it? How do logistics companies survive? I think one thing in this is we need to look at how we can work with agile companies. Logistics would have an absolute lot of opportunities in SMEs being looked at very favorably. Previously, consumers didn't work, traditional consumers who wanted to look, touch and feel before you purchase something. These consumers have moved away from touch and feel to ordering on technology, which Sri Lanka had the lowest penetration in the region in terms of B2C before on e-commerce. Now we have actually adapted it. So what does that mean for logistics players? We as larger logistics player will find it tough to get integrated and execute it fast and conceptualize it. But the smaller SMEs would have the concepts right, they would have the passion to do it, but they won't have the bandwidth to scale it up faster. So how do we get these two businesses to marry, or how do you find the equation there? So there would be, interestingly, I think in both spaces there will be immense opportunities. One is from the SMEs point of view for their sustainability and for them to scale up and grow within this opportunity frame, time frame, and from the larger businesses for them to actually leverage on this opportunity and work in the new environment. There's a new norm and a new ecosystem. How do we capitalize on that? So from the two spaces we operate in, we are working now itself. We have teams looking at what the new norm is, what are the opportunities, things we had planned for 2025 or, or 23, 24, 3-4 years from now. We have to fast track because some of those elements we've seen transpired. How do you make it into a business model now? And that's my take on that. But on a Hema's general point of view, FMCG, we are in education, we are in hospitals, but especially FMCG, we have our consumers. As Sri Lankans, I think we will be forced to be more self-sufficient. So I think what we would do is look at spaces of, I think all corporates are looking at interesting spaces where you could cater to your new existing consumers with the new norm, new consumers in spaces we have not looked at, which would have been catered through a niche SME or a startup, and that segment might grow. And interesting spaces on personal care, home care, which is the new norm, is being absolutely hygienic. Homes have to be cleaner. Your expense would be spent on certain important stuff. Your priority basket will change, as well as food. I mean, Sri Lanka had learned a lesson in this, that we had everything which was essential was imported. So in any form or shape, I think agri would be a huge place people should look at in some form, and the ecosystem of getting it to the consumers would be different to how it happened before. So we are quite, even though we are impacted in terms of some of our portfolio, and even for portfolios which won't have a longer term impact are impacted in the short term, because the entire supply chain is under disruption, the consumer channels are under disruption. But we are quite keen on seeing how we can leverage and come out of this as a healthier country and a healthier company.
Thank you. Maybe on the SME part, we'll take it up as a question down the road. Let me go on to Shantanu. Shantanu, so you are a co-founder of Bluestone Capital. You've done a couple of interesting transactions in the last 2 years, and previously similarly at Expo Lanka. So in terms of the private equity perspective, if you could cover during your presentation, what kind of sectors would interest you now? What would you consider as potentially sunrise and sunset industries post-COVID-19? Your thoughts on valuation, and as an investor, would distressed assets be of interest to you? Shantanu?
Yeah, that's a lot. So let me just start with saying that in terms of the industries and businesses that we are looking at, essentially the post-COVID world is not very different from the pre-COVID world. It's absolutely the same, according to me. The only difference is that pre-COVID, what was interesting is now on a parabolic adoption curve. So what was a linear curve, we are now on the second part of the chessboard. Quickly, we move to the second part of the chessboard, where irrelevance, and you saw that in the Intel results yesterday, how Intel itself is an irrelevant company now, is the irrelevance of the dinosaurs and the elephants is going to be exposed. And I'm going to just talk about 4 or 5 things that strike me as extremely exciting in the post-COVID world, where hopefully if there are entrepreneurs listening, even if one of them interests them, then it could be worth looking at. The first is the irrelevance of programming. You know, the TCSs, the Infosys of this world, that world is dying. Okay? deep learning, traditional programming, deep learning is going to change traditional programming. We knew that. We knew that before COVID. But that itself, the speed at which now that's going to be adopted is going to be much faster. So AI-based learning is accelerating at a speed that we can only now dream of. You know, language understanding, the fact that your computer can actually understand your language that you speak is itself such a revolution that that these things that I think this could be a very interesting part. So I'm going to touch upon these very briefly. The second I feel is automation, and the reason I sort of hit upon that is Amazon now uses 250,000 robots in its fulfillment centers, and that's because robot prices have come down. So price and cost have been a big factor in use of automation in the past. But think of social distances, think of what we are, the new world that we are coming into. And is that cost worth taking? That's the thing that you got to think about. So retail, think about what automation could do to retail, to restaurants, up to all the way to restaurants, up to manufacturing. So again, not a new thought, but just something that could go parabolic, I feel. Netflix reported earnings day before yesterday or Friday after market close. They reported 15.6 million additional users in one quarter. The expectation was 7 million users. And so people said, yeah, it's COVID, you know, people are staying at home. But what if Netflix becomes a utility? Just think about that. As Netflix as a utility, it's staggering. The thought of what that could do to advertising, what that could mean for cinema, what that could mean for data usage. And a topic that's very close to Bluestone's heart is gaming. You know, we are invested in gaming, and the gaming world has absolutely taken off. I mean, if you look at the gaming stocks, Tencent and things like that, a lot of what I'm talking about is where the money is going in the listed markets. So not many deals that are happening in the private markets, but this is the money that's going into the listed markets. So streaming of games, the ability to play games at home, the fact that social distancing will probably mean there are no sporting events for the next 6 to 8 months, and the fact that you could host those sporting events and advertising moving into gaming, these are just paradigm shifts that are just accelerating. These are always there, they're just accelerating. And the last one that I want to touch upon is, you know, the old concept of digital wallets. Now, digital wallets were 10% of China's GDP in 2014. Now, that number is 250%. So just to understand this, even USA, which I consider the most Luddite of all adoption places in the world, is now growing digital wallets at 50% year on year. So consider this, we have a whole banking and NBFI system in Sri Lanka, where even a KYC is physical, right? Lending and collecting is like a high contact sport practically. With zero or no, you know, business has been the traditional business. You know, you go after leasing, you go after small and medium enterprises, you fund something which is asset-based lending, right? Think about what happens to that when there is no or very little growth in consumption and the new economy becomes the old economy. How do you fund the new economy if you're a lender who's working in the back ages, in the dark ages? And, you know, you know, the central bank has to now move out of the 70s and just come out and say, look, there is a step change here, and we are deeply aware of the fact that we are several decades behind, and how do we leapfrog? So those are my sort of interesting thoughts. There are several others. There's DNA sequencing, which is in healthcare, there's drug development and discovery, which is fast, you know, which is interesting and things like that, but I don't want to touch upon that right now. My last point is on valuation. You know, there's a funny thing. Valuation was always reverse engineering, right? So, you know, you raised money the first time, you got a value, and, you know, it was discussed over the table and you reverse engineered it. Now, the question is, then that became your benchmark. So your last value, you've grown sales by 350%, that's your new value. You multiply that, simple, you raise money at the next level. So for every entrepreneur out there, I just have to say this, that's now out. There is no value that is not a value. So there is no benchmark. There is no previous value. There is no future value. The key here is price discovery. And you have to go back to your own investor first and discover your price. In the end, it's important always to go back to your first investor for price discovery, but this is kind of more important. And then you go back to, I guess, your VC funding, your PE funding. But remember, PE funds and VC funds right now are funding their own existing investments first, right? So, you know, you have these distress around your entire portfolio. You're not going to start saying, okay, here you go, I'm going to start a new venture. But, you know, there is going to be a bit of that. But the first funding will go to your existing children. Then you go to corporates. And you know the corporates which used to balk at, and that's where I think the maximum value lies. These corporates, a lot of these corporates are going to become irrelevant, right? And I think that's what they have to recognize. And so if there is a startup out there which they were always looking at and could not come to terms with the valuation, this is the time to go and sort of sit around and kind of a chat. Thanks.
Okay, thanks. Will come up down the road. Imal, you've been a co-founder of a successful business which recently completed a transaction, well-timed, we must say. So, in terms of your presentation, if you could talk to some of the startups out there, what were your takeaways from that whole transaction process? What now that you are part of a large organization, what is driving shareholder value and stakeholder value in this environment? What your advice is to startups in terms of raising capital in this current environment? And also any advice you could give in terms of valuations and your experience around that. Over to you, Ma.
Yeah, thanks, Yaluka. I hope I'm audible. Right. So, so as you correctly pointed out, timing couldn't have been any better because probably few weeks, maybe 1 month here and there, this deal wouldn't have gone through. Right. So the timing couldn't have been any better. So basically, I'll try to bring the valuation questions as well, because when we were doing this transaction, there were always questions about valuations, whether it's 30 million, 20 million, 10 million. Finally, we settled in a figure in between, right? So it was always what the buyer thinks that it values for the strategy that they are executing, and what we are happy to walk away with. So there's no magic formula there, right? So the first question on how do you thought that we drive the shareholder growth? Now, we were in the providing software into manufacturing industry, apparel, and apparel is the hardest hit because initially when the COVID started in China, our markets were all in ASEAN, right? ASEAN and Europe. So we thought, okay, it's good now. Manufacturing going to move out of China, and there are going to be a lot of orders for manufacturers in ASEAN countries, and we're going to have a great time. So look what happened then. Europe and US got hit. Then all the demand curve also started disrupting, not only the supply side, right? So it's basically selling software to apparel industry is it's not going to happen for next few months at least. So what we are trying to do to create shareholder value, and Zelingo also understand, because Zelingo was a company who acquired us. They were largely on the fashion value chain, starting from the consumer to suppliers to the brands, then to the factories to the cotton farms, right? So entire value chain is being disrupted. So what we are trying to do now is trying to understand where the tailwinds are, for especially trying to do some smart pivots where entire companies focus now on PP, personal protection equipment, where there's a huge demand from US and Europe, and that could kind of save the company for going forward into next few years. And that is becoming a really good revenue stream for the company, and entire companies behind making this happen on the PPE side. So now that's on the revenue side. On the cost side, basically, there's a lot of things happening within the company where US operations, the high cost operations in US, Australia, and also about 1/3 of people in Singapore got laid off, right? So these are in public information. That's why I can share. So they are quick to react to the situation and trying to, even though they're backed by Temasek and Sequoias of the world, the message is very clear. Everyone, whether you have $200 million in bank or not, everyone trying to increase their runway, get their runway into 2 years, 3 years, whatever possible, right? So it's very, very challenging in that terms, challenging times for all the companies, whether you have money or whether you don't have money, you have to do it because that will protect the future of the company. So these are the kind of things we are doing at the moment in this challenging environment. And in terms of timing, now Zelingo wanted to acquire not only us, there were few acquisitions on the pipeline. And our acquisition completed, the transaction completed around 27th December. And, we started the post-merge integration discussions in January and February. And they were still looking at pursuing those partnerships, acquisitions. And I can tell you now they're not looking at any acquisition at this point in time. Maybe things can change if a good buy comes on their way. They might look into it, but they are in the mode of protecting cash and increasing the runway and focusing on the core business. So definitely deal would not have gone through if it's 1 month here and there. Now I remember during the negotiations, we had interesting conversations with our own investors. We're going to take the exit, and also internally within the employees, because there were a few sticky points around ESOP and all that, which was dragging for about a month. And few of us, we were saying, hey guys, I mean, we had this conversation. Forget about this, some cuts you have to take, because I still remember the markets crash in 2008, and within a day, everything could change. We exactly talk about it. Hey, what if, because we all wanted to do the deal, not because we want to take the money and vanish. It's like it was the right thing for both the companies. So literally we had this conversation. We said, hey, let it go. I mean, let's not worry about these small things. Let's get the deal done. And then day we decided, and the next day we signed the deal line. We had maybe we wanted to get few $100,000, maybe $1 million more. Deal wouldn't have gone through for all of us, right? So that's the importance of timing, and also the valuations. It depends on the time. Now, what's my advice to the startups to raise capital in this environment? Any kind of money which is available to you, if you are existing established startup, take it, because money is not available readily available, as previous speakers talks about. So get whatever the money, because you're building a company. It's like your child, and you don't want child to die without food, right? So any founder would love their company to stay alive. So my advice to the founders is take the money, survival first, and then you can figure out the rest once you survive this moment. That's basically it from my side. Shiluka, if you have any questions, I can take it.
Thanks, Imal. So we'll come back to questions on that. Krishan, over to you. You again co-founder of a business that services the F&B sector. I know you're having plans or you are regional at the moment or looking at plans regionally. So if you could cover in terms of your discussion around business model text, maybe talk about your regional plans and also in the context of the current situation, your options of working with partners or investors.
Right. Thanks, Luca. So essentially, as you mentioned, yes. So we're in the F&B space. We're mainly looking at the SME clients also in the F&B space. And essentially, if you look at the F&B space over this period of time, over the past 1.5 months, it has taken a huge hit. People are not able to go out and dine out. And deliveries obviously have been limited only to essential services, where some of these restaurants actually don't qualify under those categories. So moving forward, however, what we will see is similar to a bit of deliveries that have started up over the past few days, is that we will have a continuation of these deliveries. I know two of the largest ride-hailing companies in Sri Lanka have pivoted to this segment a couple of months ago. And this will continue, where it will give more companies opportunity to come in and consolidate in this segment, as opposed to it being dominated by these two companies alone. So that's one thing that we see happening over the next couple of months. So in terms of the situation of the future of this F&B sector, one thing we can relate to is what happened 12 months ago in terms of the attacks. And for the 6 months immediately after, we saw that restaurant sales were on the down low. Some of the restaurants actually shut down temporarily, and they waited it out. And after they waited it out, one big change there was Shangri-La Mall. They held off their opening. And then as soon as we saw the Shangri-La Mall opening up in October, we saw lots of people walking in there. And the sales were back up to normal. And then that trend just continued. So I believe that would be a similarity in this context as well, where we will have the same kind of segment for about 6 months, where we'll have slow sales, predominantly focusing on the delivery aspect, and then slowly that growing back in there, where people will be more comfortable to go to those restaurants that they used to go to. So talk about if we're going to change or pivot. Yes, we are. So we kind of started a pivot 12 months ago in terms of restructuring the organization. And our target there was to actually become lean and make the company profitable. And we managed to achieve that. And as of now, we are not at the risk, because of that, we're not at the risk of running out of runway, and we're quite stable. So we're going to use this foundation to kind of launch further into the digital space. We're kind of in there, but we are definitely going to move further into that space and go further into that delivery segment and the digital segment. So that I believe is going to be the focus for OMAC and many other companies. I've been looking at some of the other applications out there. They've been doing this pivot as well. And very importantly, there have been a couple of companies that were irrelevant a few months back, and now they've suddenly become relevant. So as Shantanu mentioned, now suddenly these companies have accelerated and they have become more relevant, and there's so much of interest from investors around town to look at these acquisitions. So that is where this partnership component also ties in, because trying to do this alone, I was listening to a couple of other forums as well, trying to get through this alone is obviously difficult for startups and even SME companies themselves. So we are definitely looking at partnerships and joint ventures as we move forward. And most importantly, as you know, Sri Lanka is a small market for F&B sector. So if we are looking at investment, and if we're looking at trying to garner mergers and acquisitions, it's not going to work out if we don't have a scalable model built. And the proof of that is if we have a global partnership and if you have a global presence. And that is basically the best way to show that this is a scalable model is to basically be in foreign markets and to have these partnerships and show that this can be grown. It's not as easy as it may seem. I think lots of the startup founders out there, including Mal, could relate to this. We have to go through a lot of rejection. It's a daily routine of rejection that we have to go through. But it's a matter of perseverance and looking out for that right deal. One of the best deals that we actually put through was a very random meeting. We didn't have any planned objective. We just walked into that discussion with a completely open mind, trying to look at opportunities and see how we can kick this deal off. And then ultimately what happened was we struck one of the best deals that led to a global contract with Pizza Hut International, and that was brilliant. So that goes to show how just being there at the right time and the right moment actually helps you out. And finally, I guess in terms of mergers and acquisitions, yes, there is definitely room for that going forward. As Kasturi also mentioned, there are, as larger companies look at the SMEs, because now there's more merit in what they're doing. They've been able to, like pharmacies, grabbing a couple of tuk-tuks and solving that problem. That's where the small startups and the SMEs are actually agile, and how they can add value to the larger companies. If you take the larger companies, they're quite stable. So like a ship out in ocean, very stable out in rough seas. But when it comes to navigating those narrow straits, you need those little tugboats that come and give you that assistance to do to navigate those tough corners. And that, I believe, is what has happened time and time again, where there have been mergers, where companies who have different capabilities and different strengths have merged together with the larger companies. And that's essentially what we'll be looking at going forward as well.
Okay. Thanks. Thank you, Krishna. So thank you to the panel. I think we have some time for questions. We've got a few questions that we've got previously. So let me, the private equity venture capital space, what are your thoughts on how that sector will move forward in the context of what we've just discussed in terms of the opportunities and the valuations?
Sorry, is that to me, Shilaka?
Yes, Shantanu. Yeah.
I didn't get a question completely. What you saying?
How the private equity venture capital space will kind of react post-COVID in terms of the opportunities, the valuations.
So I think the first thing, as I said, the private equity space is doing is trying to keep their flock in good shape, right? I think that's the primary objective of any private equity company right now, is to look for funding, and if they have already got funding, then to try and sort of talk to the LPs and figure out whether that can be utilized, or there can be certain change in rules and regulations to refund and recapitalize any of their own existing businesses. Okay, so that's the first thing. Then, obviously, as I said, the post-COVID world will mean that there'll be a lot of as you quite rightly said, there are a lot of distressed assets. There are companies that are, the problem, Shilaka, we find is that if your business model is not relevant anymore, it doesn't matter how much you capitalize the company or what you do with its equity capital and how you fund it or how you restructure its balance sheet or its people, you are just going to struggle, right? And I think that lesson is a lesson that has been learned by private equity players now globally, insofar as they rather start up on their own or take a smaller company and even at a higher valuation than take a distressed asset which is just not relevant anymore, and that's why it's so distressed. And then in the Sri Lanka context, I guess the whole thing depends on how the funding requirement plays out in the next few months, really. How willing are the banks to renegotiate on a long-term basis the debt funding for the existing assets or for distressed assets. Say, suppose we do find an asset which is distressed, highly relevant, and extremely and can be turned around. The question is now, how do we restructure the balance sheet, and what leeway does the bank have in terms of doing that? Now, in terms of other countries, the central bank and the government has put aside what are called startup funds. Okay, so those funds are backing the banks. So you have quasi-government backing to do a recapitalization of some of the startups, and that depends on the banks. Whoever they think is the right one, they'll choose, they'll pick, but you'll get government backing, so equal backing from the government. So I think those are the things that private equity space is looking for. But in the end, it's you and I both know that private equity and venture capital, the biggest deals happen at the middle market and not in the extremely distressed situations, unless you're sitting like, luckily on just having raised a fund and just literally sitting on 70% unutilized assets, which we aren't, unfortunately.
Thanks, Shantanu. Thank you for that. Kasturi, there is a question from the audience, which I think you might be best. It says, what is your advice for 3PL specializing in providing logistics, mainly for the apparel companies? Any thoughts around that?
So while apparel might be taking a bit of a slow recovery, 3PL or 4PL for domestic logistics is very important, because for the next, till we get a vaccine and how we see the how the virus seems to be spreading in communities, this social distancing and minimizing exposure is here to stay. Having said that, we also see consumers have moved into a different way of purchasing, the channel movement. So 3PL alone was not enough here. We had to get integrated into scalable last mile delivery systems, plus getting e-wallet involved in this whole process, which we don't have actually in Sri Lanka. Plus having a uniform tech piece to actually transfer all the data in. So we don't have that as well. But I think all of these companies in 3PL, I think one way is they could look at consolidation, look at how can the ecosystem be mobilized to get in to the FMCG, to the food industry, to pharmaceuticals, to any other product which a consumer is buying in a domestic scenario, without stopping at the first leg of a depot or a retailer. It should move beyond that. So I guess it's for them to see how closely they could work within each other's ecosystems, collaborate together, and how can they come up with regional solutions. Maybe it doesn't have to cover the whole island. You can break it up and do regionally. You could even work backwards and plug into the food industry, maybe to one FMCG company, maybe. But what I feel what we lacked is we had very little common distribution. Sri Lanka had created their individual distribution networks. And when it came to, with a situation like COVID, we needed common distribution networks where we could co-load, optimize, have minimum contamination, minimum contact, and minimum amount of assets on the road. So this means a lot of technology and data is needed in 3PL and 4PL space, which is connected amongst all the players in the value chain. I think all of you all there is room. There is, because Sri Lanka, one thing is, for example, if I just say for the healthcare, you had the postman who didn't deliver letters delivering medicine. And it was a simple WhatsApp given, because we didn't have any tech piece to connect the postmaster to the Osusala or to the closest pharmacy. Nor did we have a tech piece where the pharmacy would know what the next purchase of the consumer's requirement is going to be. Because remember, from a healthcare, if you break it up, you'll know what is a regular purchase, what is a monthly purchase, what is an ad hoc purchase. You could see it in your consumer products, you would see it in healthcare. If you have an NCD, if you break it up in terms of diabetes or cholesterol or whatever, you know it's a monthly purchase. But we don't have that data. It's somewhere in some clinic. But we had it, we could have proactively given. If you saw the pictures of old people standing in queues, it's because they have some form of NCD and they need that drug. So I think this is the time all of you all have to mobilize, think, how could you solve these problems? These problems are going to be here to stay. It's going to be aggravated because all the people, the patients going into the state hospitals will avoid it and go into private pharmacies, but their clinic data is within the state hospital. How do you buy your medicines from the OSU seller closest to you? So there are a whole host of problems. We managed to come out of it in the last 4 weeks through very, very rudimentary solutions. We didn't have one single data point. We see cracks in it because there was no e-wallet. So you have SMEs tanking, the middleman tanking, unless a big consumer comes, corporate comes and bails them out. So I think all these the 3PL providers in apparel, why don't we look at it from a domestic point of view? Why look at it only from a re-export and consolidator and entrepot point of view? You might have to turn back and look into your assets can be reused.
Thank you, Kasturi. I think that is very clear. Shantanu, would you like to add anything from your days at Expo? Or?
I think that pretty much covers it. I think the logistics, it's interesting. The one thing that Kasturi said, in logistics, it's everything is now basically based around logistics. But one piece that really will put the whole thing together is the payment piece. And I think unless we can solve for that, you can't really do logistics at a scale and tie the whole value chain in. And I think that's really where we are missing. I think the rest of it can be done, but that other one requires some regulatory changes.
Thanks, Shantanu. Imal, I think there's a question for you around your IoT platform solution and whether that can be adapted to different sectors like healthcare and agriculture.
Yeah, I think it's a great question. So basically, when we built Insinga, it was built as an industrial IoT platform. That was the initial idea. And then when we got the traction in apparel, you had hundreds of factories in Sri Lanka and thousands of factories in Bangladesh, India, Vietnam, Indonesia. So we saw the opportunity to replicate. So the biggest barrier was the domain knowledge, and so we decided to go and replicate. So every country we land in, we know who are the owners, who are the manufacturers. We just call them and show the product and they buy, right? So it's a very, very targeted approach. Now in this scenario, it's not happening. So the product can be adapted to any discrete manufacturing, and we are looking at essential manufacturing, which is pharmaceutical manufacturing, food manufacturing, agriculture. So these are the essential industries which are operating, which are trying to scale, and they need to automate certain things and they need to do things fast given situation. So we are looking into those industries, and that's possible. That's what we are trying to do at this stage.
Thank you, Imal. A question, I think we have probably time for one more, I think to both Imal and Kashani, in terms of the support from the government startups. There's always, I think this, in the current context, most of the loan funding might be channeled towards the larger sector. What would you ask from the government in terms of support going forward, ideally? So Imal, starting with you.
Yeah. So I've seen this government or the working capital loans, right? So Now we also applied for it. I just wanted to see how they react. So basically, now they comes and ask for collaterals to give that working capital. Now, what kind of collaterals IT companies have to give it to the banks? Because your collaterals are in your head, right? So the intellectual property. There's no bank in Sri Lanka consider IP as a collateral at this point in time. So it's a bit challenging. I mean, I don't know whether they're trying what they can keep. It's something that the commercial banks are doing, or is it the advice from the government? I don't know, but I think it is challenging even to get what is being advertised and what is in offer in the process. That's what I see at this point in time.
Thanks, Imal. Krishan, any thoughts from your side?
Yeah, so well, funnily enough, we are having the same problem as Imal mentioned as well, is that if we ever look at the traditional banking system, IP is not considered an asset, and it's always security-based lending. So even as startups, if you're trying to maintain a healthy debt to equity ratio, you can't maintain that because it's very hard to raise debt as an IT company. One of the main things now, if you look at the teachings of lean practices, is actually to let go of unnecessary processes, and that's precisely what we did by letting go of all of our fixed assets, rentals, all of those were let go of. And we went into a serviced office space where we don't have to worry about maintenance of facilities and things like that. Let somebody else worry about that, and we went completely lean. But then this turns around and becomes a problem when we're trying to raise debt, because obviously you need to have some collateral being kept as security, and the banking system is not geared to handle this. It hasn't been geared since, I don't know, for the past 3 years, and even as recently as last week, they still look for security, even though the IT sector is one of the segments that is um, uh, highlighted as one of these sectors where they're looking at giving working capital. I don't see how they're going to do this if they're still looking at security, because it'll have to come down to personal assets if that's the case for security.
Thank you, Krishan. Shantanu, one last question for you. In terms of, there's a question around the missing payments piece. This question is, what is missing and what should happen? And maybe a follow-on is, since you have, what your thoughts might be to the startup community in terms of financing.
Yeah, so I missed the last part, Shilaka, so if you can just type it out for me, that'll probably be the easiest. So look, the value chain, the value chain around logistics is based around greasing every part of the logistics value chain, and the grease comes from funding. So you fund every part of the chain, and it's non-secured lending, it's unsecured lending essentially that you're talking about, and it's lending based on cash flows and the visibility of those cash flows, right? So there are a lot of missing pieces around the technology part. I'm not too worried about, but there are missing pieces around what the central bank will and will not allow, and we can take that privately, right from KYC up to minimum values, up to secured assets, about keeping things in even physical ownership of custodia of assets and things like that. That really are, I think, antiquated in a current world where if you have the ability to understand a company's cash flow, then you can quite literally see visibly its cash flow on a daily basis. Then you can actually lend against it. And these are things that that technology is not stopping you doing. It really is the regulatory atmosphere around this that is stopping.
Thanks, Shantanu. So the second part of the question was really in terms of financing. Since you have an investment into NBA5, what would be your thoughts around financing for the startup sector or the informal sector?
Yeah, so I mean, from what I hear, you're talking about financing of the NBFI or financing of or their loan, financing of
Startup.
yeah. So look, NBFIs won't be financing startups. I think that's unlikely. I think in terms of financing the NBFI, of course, there's a challenge there because you have a completely different ball game in front of you, which is the moratorium on debt collection and the cash flow issues around that. But I think the bigger challenge for the banking system and the NBFI system is even when we come out of this, what do we fund after that? And I think that's really going to be the interesting part. And you know, I think that's where the challenges lie ahead in terms of funding. But if I can understand your question correctly, for funding of startups, I think that's going to be unlikely from a point of view of for NBFI.
Thanks, Jonathan. There is one more question on the chat. I don't know whether you can see that for you.
Yeah. So the question is, most investors are flocking towards safe havens and low risk investments. How will this impact the liquidity available for private equity? Can we expect any premature exits on existing private equity investments in the near medium term? Well, most investors are flocking towards cash, right? Cash and the yellow metal are really where the safe havens are. So does this mean low risk investment? I completely disagree. I completely disagree that investors are moving away from low risk investments. I mean, if you look over the last 4 weeks, say from the 1st of April to now, and you look at just the listed markets, because I don't have complete visibility on where private equity funding has gone, and I suspect it hasn't gone many places. The investment really has not been into low risk investments. It's been into investments that they see are a sure shot in the new world, right? And I think even if those investments like Blue Jeans, like the takeover of Blue Jeans, at that kind of valuation, twice that of Zoom, I don't see that as a low risk investment. I just don't. It's not an investment without risk. It's an investment with a heavy amount of risk, and it's come at a huge multiple. But it's got tailwind, right? And that kind of investment is the kind of investment they see over 10 years being able to play out. So premature exits on existing PE investments in the near term, I don't see an exit. I don't see the IPO market coming back for another couple of years. I think the only exit that can happen is if your asset distinguishes itself from every other asset in the market. There has to be something that distinguishes you. And that's going to be the tough part. It's not going to be scale. I'm telling you, it's not going to be scale. It's not going to be your immediate NIM, your net interest margin, or your traditional methods of valuation. It is what distinguishes the method in which you do business to make it relevant for the new world. So the earlier exits are you can just forget about them.
Thanks, Shantanu. Imal, there is a question for you in terms of from the chat. Do you think there are opportunities for talent acquisition deals are there opportunities for, say, the larger corporates to add talent via acquisitions? That's my understanding.
Yeah, definitely. I think as Kasturi mentioned initially, like, the big corporates need startup-like approach to solving certain problems, right? Given the current situation where the speed is the key, right? And on the other hand, there are a lot of startups are struggling. We used to operate in 3 to 6 months runway. I think we wouldn't have survived in this kind of situation. And even I got certain calls from certain companies where they're happy to let go certain departments of certain good companies next to nothing, right? So they just want the teams to survive and get the jobs. So there are a lot of opportunities for the talent acquisition, and there are a lot of people are laying off or cutting salaries at this point in time. So in that kind of environment, there's a lot of opportunities for talent acquisition, and it's if you are sitting on good amount of runway, and if you are believing in yourself in the long run, I believe you should acquire those talent, and this is the best time to do that.
Thank you, Mal. Probably one final question, and this could be either Kasturi or Shantanu. There are, I mean, if you look at the US, Europe, and even places like India, there are restrictions being brought in on foreign investment from certain. What are your thoughts on that? Is that something we need to look at and take off for? Just open question.
So I didn't hear your question, Shiruko. It just broke in the middle. Something about US and then.
Yeah, sorry. So to essentially whether we have certain caps on FDI in Sri Lanka in sectors like logistics, shipping, education. Do you foresee that these should be maintained, or there are opportunities in this context to take those out and make it a more open or level playing field?
I think there is, so there, firstly, there is no FDI cap in logistics. There is FDI cap in maritime, and there is an FDI cap in terms of courier, in where you control freight and courier, and certain essential services in terms of how they own it. But now I guess anything which if you look at a logistics space, anybody who's willing to bring in money and set up infrastructure, I think it has always been open. But now, more importantly, what the BOI I think should look at is bringing in some, removing any restriction. So there was no restriction for anything else. There were restrictions based on certain parameters of certain industries. But for everything else, there was no restriction, but there was no encouragement to enlist these people to come and invest here. So the tax reliefs were, because we were abiding by the IMF's guidelines, there was not much of tax benefits, because if you look at Sri Lanka, our labor force is not the cheapest compared to the regionals of Bangladesh and Vietnam, say. Our electricity cost is not the cheapest. Data, I think we are one of the cheaper and better quality data we've got. But the rest of it, it's very tough for us to compete. Raw materials are not accessible. So now I think what we would need to do is open up all industries, because we need to be self-sufficient. Look at new industries to be where we can function as exports, not the traditional exports, and remove wherever the caps are, which is not encouraging growth. So I think the caps which have been existing were existing purely to make sure that the foreign income the exchange didn't move out in terms of dividend too much, and not in terms of curtailing growth, because growth was anyway there. Wherever you have, if you have space like logistics, you should look at getting FDI in. But most importantly, on newer industries, electronics, agriculture, I think we should encourage people to come in, and or our local industries to invest and look at maybe for export, self-sufficient as well as export.
Thank you, Kasturi. Shantanu, any final thoughts on that?
Well, yeah, I mean, look, there isn't a queue of people waiting outside Sri Lanka right now, knocking on the door saying, I want to invest. It's not. So I think to actually even say that, we will have some FDI restrictions is just, I agree with you. I think there's no point. There is no reason why an industry in Sri Lanka should be protected. If its relevance anyway is going to be irrelevant, it is going to be completely gone in about 10 years. I think the key here is not so much whether there is a queue of people waiting to invest. The key here is what can we do to bring the queue of people to invest. And I think there lies just the answer is quite simple. It's remove this sort of set of protection around industries here, which has been existing for almost 50 years, because there is no statistical proof that FDI results in outflow of dollars, right? In no country that has been the statistical proof. It always is a net inflow. There is no statistical proof that FDI coming into a country results in local people losing their jobs. That is no statistical proof, right? And there is also no statistical proof that FDI coming to a country has made some of the local large behemoths irrelevant. It hasn't happened because of FDI. It has happened because they were anyway going irrelevant. So I'm not, I think the key here is for Sri Lanka to say, look, we have a small consumption, 22 million people. We have a reasonable GDP per capita. We have, something that maybe the access that India hasn't given, we are able to give for the region in terms of transport, particularly, and logistics. And it's regionally very well placed for both those things. So yeah, I think that should be opened up.
Thanks, Shantanu. So I think we've gone slightly over time. I'd like to thank each and every one of the panelists for a great discussion, some interesting thoughts and talking points. And I'd like to hand it over to Kishan to wind it up.
Yes, thanks, Shiduka. Yeah, I think it was a good session. We just ran a little over time, but I hope there is some takeaway for everybody who was on this call. So on behalf of KPMG, Sri Lanka, and BOV Capital, thank you to all the panelists for taking their time to share their ideas, thoughts with us today. Also, we want to thank all the participants. You guys have been really awesome. You guys have stuck around for more than 60 minutes with us, despite a few of the technical issues that we've had. We apologize for that, but yeah, hopefully this was a good session for you guys. We are also trying to host another session next week on retail. We'll keep you posted. As always, we wish you to be well and safe. Have a great rest of the evening. Thank you. Bye-bye.
Thank you.
Sure.
Bye.